Imagine a book written way back in 1958 that is still considered absolute required reading by the greatest investors in the world today. Why? Because it fundamentally shifted the entire investing paradigm from purely quantitative math to qualitative mastery. Today, in this explainer, we are diving deep into Philip A. Fisher's timeless wealth building framework, and we're going to figure out exactly how to find extraordinary wealth building machines before the rest of the market even catches on. You know what's really fascinating here is that Warren Buffett, yeah, the greatest investor of our time, actually credits his most profitable insights not to spreadsheets, but to the exact philosophy we're unpacking today. From Benjamin Graham, Buffett learned safety and discipline, but from Fisher, he learned how to spot the massive future potential of a company. And honestly, that 15% might just be the most profitable 15% in investment history. So, our source material today is Common Stocks and Uncommon Profits. First published in '58, it was literally the very first investment book to ever make the New York Times bestseller list. It proved once and for all that building long-term wealth is about understanding the actual soul of a business. It's not just staring at balance sheets. It's about people, ideas, and character. All right, Section 1, The Man Who Changed Investing. Let's look beyond the balance sheet. Back in the 1930s, Wall Street's status quo was entirely focused on the numbers, but Fisher totally broke the mold. He realized that while math gives you a snapshot of the past, it's the people, the ideas, and the integrity that act as the engine of the future. Evaluating management and corporate culture tells you where a company is going tomorrow. If you truly want uncommon profits, you absolutely must search for those uncommon qualitative traits. Moving right along to Section 2, the power of Scuttlebutt, or as I like to call it, the detective's method. To get that qualitative edge, Fisher operated way less like a traditional suit and tie analyst, and honestly, a lot more like a street detective. He called his revolutionary method Scuttlebutt. Basically, this means bypassing all the Wall Street noise to discover the living, breathing reality of a business through frontline sources. Think of an annual report like a basic roadmap. Sure, it shows you where the streets are, but it tells you absolutely nothing about how the city actually feels when you're walking around in it. Scuttlebutt gives you that reality on the ground. Instead of just reading those highly polished corporate statements, you build a network. You talk to the customers who actually rely on their products. You interview suppliers who know their buying habits, and you find former employees who know the real internal culture. You're evaluating a company just like you'd evaluate a friend's reliability based on their past behavior. Actually, a pro tip here, competitors are surprisingly candid when you just ask them who they are genuinely afraid of. Look, if you take just one single thing away from this whole section, let it be this. Your true market edge comes from information that hasn't shown up in the financials yet. By the time a great company's success is perfectly clear on a spreadsheet, the stock price has already moved. Scuttlebutt allows you to build the mosaic before the rest of the market even catches on. Okay, Section 3. Let's get into the meat of it. Fisher's 15 points of quality. The master checklist. Fisher actually had this incredibly strict 15-point checklist to separate average stocks from massive wealth builders. We've compressed it into 3 core themes for you here. First up, products and R&D. A great firm needs massive product potential and a sales force that can actually execute. Second, management and integrity. They need unshakable honesty, especially when things go wrong. And third, financial margins. They absolutely must have the profitability and cost controls to fund their future dominance. And right at the heart of this checklist is this single, just stunningly cunning question. What are you doing that your competitors aren't doing yet? That emphasis on the word yet completely embodies Fisher's philosophy on continuous innovation. A company that is constantly asking itself this question never becomes complacent. So the big takeaway here is that continuous innovation is literally your only true defense against obsolescence. A company that rests on its current products is a company in slow decline. Fisher wanted management that was always obsessing over the next generation of growth. All right, Section 4, when to buy and sell, and the heavy psychology of holding. Fisher believed the absolute optimal time to buy is during temporary market panic. You want to capitalize on short-term fear to acquire long-term resilience at a totally fair price. When a truly great company hits a temporary roadblock, maybe it's a product delay or just a broader market dip, the crowd panics. But for the focused learner applying Fisher's method, temporary adversity is just a massive buying opportunity. Now, when it comes to selling, Fisher had a really strict, highly actionable 3-step checklist that leaves absolutely zero room for emotional trading. You only sell if 1. You made a clear mistake in your original analysis. 2, there's been a fundamental deterioration in the company's core qualities. Or 3, a significantly better opportunity exists and you desperately need the capital. Notice what's missing here. You never ever sell just because the stock went up. Because outside of those 3 very specific scenarios, his ultimate rule for handling an exceptional company is basically just almost never sell. Let the compounding work its magic. Fisher watched people sell their best wealth-building machines just because they doubled, only to watch those exact same companies grow another 10 times in value over the next decade. Which brings us to Section 5, debunking dividends and diversification. Time for some contrarian truths. Listen, if you're truly serious about building long-term wealth, you have to understand that chasing high dividends often traps you in really slow-growing companies. We're always taught that dividends mean safety, right? But Fisher argued that great businesses reinvest that capital to generate far higher returns. Think about it. If a company can earn a 20% return internally, why on earth would you want them to pay it out to you as a taxable dividend? Reinvesting for growth is where the real compounding happens. And get this, Fisher famously argued that over-diversification is really just a disguise for ignorance. It's exactly what Peter Lynch later called disworsification. Fisher believed that owning 50 average stocks that you barely even understand is infinitely riskier than deeply understanding a handful of truly exceptional ones. The absolutely crucial point here is that focusing your portfolio on your absolute best, most heavily researched ideas is the true path to safety. Remember this. Concentration with deep research is conviction, not recklessness. Real safety comes from knowledge, not from just blindly spreading your money around and hoping for the best. Let's bring it all home with Section 6, the ultimate proof of concept, Fisher's legacy. By blending Benjamin Graham's strict quantitative math with Philip Fisher's profound qualitative insights, Warren Buffett completely transformed his entire strategy. He evolved from buying fair businesses at wonderful prices to buying wonderful businesses at fair prices. That intense focus on management integrity, sustainable moats, and holding forever, that is Philip Fisher's enduring legacy, very much alive in the market today. So as we wrap up this explainer, I want to leave you with a really provocative question to chew on. Which of Fisher's 15 points will be the cornerstone of your wealth-building strategy? Which qualitative edge are you going to start looking for tomorrow to uncover your own uncommon profits? The entire framework is right here. The Scuttlebutt method is just waiting to be used. Now it's totally up to you to do the uncommon research.